So the 30-year fixed mortgage has been getting better the last couple of weeks, which is super great if you're in the market to buy or you're waiting for rates to come down to potentially do a refinance on your mortgage. You can see here this blue line right here. This represents the 30-year fixed mortgage. This is dating all the way back to 2023. And you can see here how the 30-year fix has been fluctuating. And this blue line is the 30-year fixed mortgage. So right now we're sitting at about 6.5% on a national average 30-year fix. And this is a 10-month low from where we saw interest rates back in January of this year at about 7%. In a couple weeks, the Federal Reserve is going to more than likely cut interest rates. And a lot of people are maybe waiting for this because they're waiting to say, hey, if the Feds cut rates, that means that interest rates will get better. The 30-year fix will get better. That means that your mortgage payment will be lower if you're waiting to buy, or maybe you're waiting to refinance for that 30-year fix to get even better than where it's at today. Now, I don't have necessarily a crystal ball on this, and I don't think anyone else does, but I do want to show you some historical data that may show you that the 30-year fixed mortgage does not exactly follow what the Feds do with their federal funds rate. I'm going to show you this graph here. And what this graph here shows you is this red line. This is the 30-year fixed mortgage dating all the way back to the year 2000. The blue line is the federal funds rate and what the Feds have done in history when they lower. This is the pandemic, so they brought interest rates down for the federal funds rate almost to 0% here. You can see how interest rates were at zero for a very long time. And look at this, the 30-year fix did follow the federal funds rate down. And it's obviously not in a very straight line, but you can see here that last year, the Feds over the last 12 months have been keeping that federal funds rate exactly where it's at today. It's right around that 5 to 5.25%. They lowered the federal funds rate in September of last year by 0.5%. Interest rates on the Federal Reserve, they lowered that by 0.5%. The 30-year fix, however, it actually increased from that move. You can see here, a lot of people might have been on the sidelines, and we were able to refinance a lot of our customers back last year in September and August and September when interest rates were coming down. And a lot of people stayed on the sidelines on their refinance. And the reason why is they're like, hey, the Fed's going to cut their interest rates. We're going to wait for interest rates to get even better. Now, that would have been great. I would have loved that. However, what happened is when they lowered that federal funds rate, the 30-year fixed shot back up. You might be scratching your head and saying, Pete, why did the 30-year fixed rate go shoot up a lot higher when the Feds lowered their interest rate? Now, there's many things that go into this, but the long answer is that there's not a direct correlation with that federal funds rate. And it's not exactly true that when the Feds lower that interest rate that the 30-year fixed rate does get better. I truly believe that we will see interest rates get better over the long term, over the next 12 to 24 months, because inflation is going to get better. And right now, inflation is sitting about 2.9%, almost 3% a year. That basically means that your eggs, your milk, all these goods and services are going up in price about 2 to 3% per year. Now, the Federal Reserve, they want that to be under 2%. They want inflation to be under 2%. They don't want the goods and services going higher in cost by more than 2%. And so that's why they changed that federal funds rate up and down. That's also why the 30-year fixed mortgage will change up or down. And ultimately, when we have low inflation, we're going to have low long-term rates, lower long-term rates. And so I wanted to do this video so to help you understand that it's not always the same, and that if the numbers make sense right now today for your refinance, maybe you can save $200 to $300 on your payment. If you have an interest rate of maybe 7 to 8%, definitely take a look at where interest rates are at today and how much you can take some money off the table for your savings. Because if rates do get better over the long term, well, of course, you can look at refinancing again if rates do improve. The same thing if you're looking to purchase and if you're in the market to buy, definitely look at the home, look at your affordability, look at that monthly payment, make sure you can afford it. The nice thing right now is inventory is about 20% more, at least in our market here in Shasta County, 20% more, which means that you can negotiate a good price. You can negotiate some seller credits on your house. And so don't necessarily wait for the feds to make that decision, because it's not always a direct correlation. I would look more towards your current situation, maybe take some money off the table, and then of course you can refinance later on if you're either buying or maybe you're looking at refinancing right now. I hope this video was helpful for you. If you have any questions, reach out to us. We're always here to help. Thank you so much, and we'll talk to you guys very soon. See ya.